do you worry about the most in 2024?
Yeah, I mean, I must say 2024 is starting off from a banking perspective quite well. We know all the problems in the world, and we are always concerned how those are going to affect the operating results of our bank or others or our customers. So far, so good. I think the economy is in a reasonably good place. Of course, the tensions that are carrying over from last year are still there. Obviously, the war in the Middle East is a big preoccupation, and concerns that will spread, although it seems manageable so far from an economic perspective, yes. Obviously, perhaps not from a humanitarian perspective. And likewise, conflict in Europe, and likewise, the geopolitical tension. So, but these are, I won't say we're used to these things, but they've been around for a while. It would appear that no one has an interest in taking very substantial specific conflicts and turning them into major global operations. And I hope I'm not wrong on that.
Yeah, we were expecting, I guess, the economy to really suffer more than expected in 2023. Yeah. Does that skew markets thinking on how resilient 2024 is going to be?
I think there's a risk of some complacency building in, that because we haven't had a big interest rate related correction in economic activity so far, that we're out of the woods. But obviously the signs are encouraging, and I think there's no doubt that in order to complete the fight against inflation, we're going to have some slowing economic activity, and in particular, we're going to have a slightly less robust jobs market, in particular in the U.S. But it's very robust right now. But things are going in the right direction. Yep. When I look at China with their GDP figures yesterday, yep. in line with expectations, I think China's going through a very major transition in their economy from old economy to new economy, and dealing with the aftermath of the geopolitical tensions and tariffs and restrictions and things of that nature. And China plus one, we know the story. And I think against that backdrop, China's actually doing quite well. Yep. The new economy sectors are booming. Yep. And the old economy sectors are really struggling, led by property. Yep. So I look at that whole equation and say there's plenty to be optimistic about in 2024. Yep.
But so what do you do with property in China? Again, it's unclear how the authorities will deal with it. What kind of leeway they have or appetite they have yeah. for letting some steam out.
I mean, for us, it's a relatively small problem. We've taken some losses over the past 3 years. Our credit losses overall are very small. Mm-hmm. The bulk of them have come out of China. So it's not a huge preoccupation. Mm-hmm. I think the Chinese authorities have stabilized the property market, but it hasn't corrected, and it hasn't fully, the prices haven't cleared, right? The market hasn't cleared. Mm-hmm. So I think we'll see some ongoing support measures to just let the market equilibrate. Mm-hmm. But that's just one part of the old economy in China, the historic drivers of GDP growth that are in reverse, and some other elements of the really heavy manufacturing sectors and some other more commoditized manufacturing are moving out, either through the China plus one or cost competitiveness. And I think the result of that is China has to focus on growth in the areas where the growth opportunities are there for them, and they are. They are. But
so if you look at 2024 and beyond, what do you do with India, for example, from an economic perspective?
In India, we invest heavily. India it's a fabulous growth story for years to come. The economy is quite a bit smaller than China, but they're determined to catch up, and over a period of time, I think they can.
What time frame? Is it difficult to say?
The Chinese economy, and GDP per capita in China is in India is 1/4 of China. So, a long way to go. But if China closed the gap to big chunks of the middle income world over a 20-year period, I think that's a reasonable aspiration for India as well, and they're well on that track. If they can consistently generate 7-8% growth, yeah. which they should be able to.
Talk to me about the Fed. So the market is definitely pricing in a lot of cuts.
Yeah.
From the Fed, I don't know what that means for your trading floor. Are they ready? We could see a lot of volatility.
We could. Although markets have been quite well behaved. I think the Fed has done a good job of forecasting and indicating for guidance their intentions. I think the market might be a little bit ahead of itself in terms of rate cuts this year. I have no doubt that we'll get to rate cuts at some point. I suspect it'll be a little bit later in the year. So we have this debate within Standard Chartered all the time, and we're positioned in terms of our from a treasury perspective. We're partially hedged, but we're okay. Sitting tight for a little bit on the rest. And
where do you think treasuries are headed?
We've seen a big correction in treasuries, right? With 10 years dropping almost 100 basis points. That's a big move down. if we think that the stable, long-term risk-free rate, the short-term rate, is going to be something like 2.5 or 3%, then Treasury should settle somewhere around where they are, right? Somewhere around 4%, which I think is probably pretty healthy for the economy as well.
Yeah, when you look at trading, I don't know whether you're starting to now try and calculate what Trump in the White House means for policy, for markets, for trade.
It's very hard to know, right? And we know that the deficit ballooned under Trump pre-COVID. Obviously, it ballooned during COVID, but it didn't balloon any less under the Biden administration. So, where we go from here, I mean, there's very little sign of fiscal discipline from either party right now. Which is, I think, concerning. But reality finds ways of biting.
What does that mean? Like a treasury auction that doesn't work? I mean, could it be really ugly?
It could be. I think it's much more likely that you just get a little bit of a buyer's boycott, and you see treasury yields that are not behaving consistent with the way the Fed would like short-term rates to play out. And a failed auction would certainly be a message, but I think that would most likely be... Is
that possible in the short term?
It is, but I think it's much more likely to be attributed to technical features of the Treasury market. And of course, I mean, you've spoken with a number of my counterparts at the U.S. banks who are very concerned about the capital rules that are coming in place and the degree to which it hits the trading books, which would have the effect of withdrawing capital from that market, which is already pretty stressed. So I think it's much more likely to be a technical thing than a fiscal thing.
I mean, are we so sure? We talk so much about what Trump in the White House means. Or do we know, or do you understand, like what policies a second-time Biden administration puts in place?
Well, I would think a second-time Biden administration would find some fiscal rectitude. Okay. And I think they inherited an economy that was coming out of COVID and made sure that things. The pump stayed prime, as it were. I mean, we had a significant cost of living crisis at the time for all the reasons we understand. So I think that the Biden administration, led by the Secretary of the Treasury on the economy side and the Fed, are very orthodox. And no country can run the kind of budget deficits that the U.S. is indefinitely. So, and I think they're very orthodox, and I think they would take a conventionally orthodox approach. Probably not going to hear much about that before the election, but that's politics.
Bill, HSBC also has Zing, which is basically trying to rival Revolut and Wise. I mean, do some of the big banks really have a chance of going after these fintech companies?
Oh, I mean, absolutely. We've set up a dozen digital banks around the world now. We've got cross-border payment platforms. We are... dare I say it, there's really nothing that you could do on Revolut or Wise that you can't do on a Standard Chartered or many other bank mobile apps.
So why are we not?
We are. I mean, our business, I think last year, we completed 82% of our transactions were straight through, no human contact. I don't know if it's the highest in the banking industry, but it's a very high percentage. We may be the only bank that actually discloses that figure, so it's a little bit hard to know. But no, we've learned from these guys. I mean, when we set up our digital bank in Hong Kong 4 years ago, we looked at the best in class of digital banks around the world, including...
Which is? Who's best in class?
Well, we looked at people like N26. Revolut is very good. We looked at the digital offerings in existing banks. We benchmarked ourselves against those, and we came up with something that we think is best in class. We're so happy with it that we rolled out the same tech stack in Singapore. We gotten almost 15% of the bankable population in Singapore has opened an account with our digital bank in Singapore. It's called Trust Bank. It's the fastest growing digital bank in the world. Now, it's Singapore. It's obviously if we could do the same thing in China or India, we'd really be in the money.
And the UK?
Or the US. No, the UK, I think, is pretty thoroughly banked. And starting with the banks that you mentioned, banks like Monzo, which are excellent, in addition to excellent local banks. And we don't have a retail presence in the UK. But we do have a banking license. We do have a banking license.
Which others don't.